Felix and Winston here, and as the Nasdaq suffered its worst drop since 2022, well, the March market crash has created a hidden opportunity in companies using AI to cut costs massively by up to 50% while everybody else is struggling. And it separates companies press releasing AI from those who are actually going to come out of this shining like little Winston here. And I want to walk you through the macro, why the market is actually dipping, because I think it's really important to understand. And Winston did all the research on that. And then I want to walk you through several stocks that are related to Palantir and are implementing AIP better than anybody else out there, and give you some buy opportunities that you might want to study so that you, if you don't have a nose this large, know what to potentially buy as the market recovers. So what's happening right now? We're witnessing a genuine market correction. The VIX, the fear index, has spiked above 20. Big investors are unwinding positions at the fastest rate in over 2 years. And bearish sentiment has reached levels we haven't seen since 2009. Remember the global financial crisis? That was fun, wasn't it? Now, for those of you here short on time, here is the essence. This market downturn isn't just time to panic. It's revealing a fundamental difference between the companies that can weather economic storms and those that can't. And Winston and I have analyzed how true AI implementation, not just the press releases, a lot of them are doing, creates tangible competitive advantage in this crazy market we're in right now. So I'm going to walk you through the economic indicators, the market sentiment shifts, and the practical framework for actually identifying the winners. And I'll tell you what I believe our winners are here. Look, I've spent years in trading and watching how institutional money moves during corrections. What separates the winners from the losers isn't market timing. It's identifying businesses that fundamentally are improving their resilience. And the data I'm about to share with you cost us hours of research. We analyzed the March AIP showcase, where companies revealed exactly how they're using AI to cut costs when it matters most. Now, Winston, who's roaming around here somewhere, deserves most of the credit here. Well, he was sleeping under my desk during all of those late research nights. And honestly, I think he has a sixth sense for spotting outperforming stocks and snacks. I think he's just gone off to the kitchen. But before we explore this economic landscape in detail, I want to give you something very, very important. And if you'd had, or I'm about to give you, about a month ago, your portfolio would be looking at 10% better right now. Big promise, I know. But what I'm going to do is give it to you completely for free, no strings attached. And watch it and learn it in your own time. And it's the rules that I was taught by traders and investors who'd done what I'm doing now for 20, 30, 40, 50 years before me. And I've taken all of those rules, all of those key sets that literally a beginner can implement from today into a very, very short 15-minute masterclass, because I know a lot of people don't have a lot of time. So I want to make it accessible to you, because this is what everybody should be taught at, like, grade 9 or something. They should be like drilled in. They should just scrap the whole maths thing and geography and chemistry and all that nonsense and just teach this, because if you know this, your life will be better. How do you access it? You go to felixprehn.org/get free and take notes, take screenshots. Watch it again if you like. You can do it several times, and it's going to give you that foundation that you need to make sure you get the most out of these market patterns, because this is a pattern we're living through right now. And the reason I'm smiling is that I know what the pattern looks like, so I know what to do. Now, let's get serious here. What most analysts have missed about this current market downturn is how it's revealing which companies can actually fulfill their AI promises and those who are just riding the hype cycle, the fugazi. And quickly, look at what's happening last week. We're seeing some genuinely alarming market movements. On March 10th, the Nasdaq plummeted 4%. That's the steepest drop we've seen since 2022. The S&P wasn't far behind, and the Dow dropped like 2%. So why does it matter? Well, these aren't just random fluctuations. When markets breach key technical thresholds like the 200-day moving average, which, by the way, just happened, and I'll show you a chart in a moment on that, it triggers a cascade of selling. See, many sophisticated investors use the specific threshold as the exit signal. So if you understand the pattern, you can actually exit slightly before they do. Feels much better. So they'll sell when prices drop below this level and only buy back in once we elevate back above it. And I've literally seen this pattern play out dozens of times in my career, and I know people who've seen this pattern play out hundreds of times because they're like twice my age. So if you're thinking, is this just normal market jitters? No, absolutely not. This represents a systematic rebalancing driven by macroeconomic factors and policy shifts like the new White House. And let's talk about the VIX for a moment. You know that market fear gauge, when it drops below 20, that typically signals lower anxiety. People have taken their meds. But guess what? Recent days have seen it spike over. We were at 30, well above 20. And that's telling us the market remains in a state of underlying tension, right? So the tension is still there while you're over 20. So what are the big players doing? According to a Goldman Sachs report, and Goldman Sachs is probably the most respected investment bank out there, if the word respected and investment bank go together. My investment bank friends are going to love me for that one. Now, what are they doing? They're unwinding their positions in single stocks at the fastest rate we've seen in over 2 years. Now, I did say in single stocks. That's important. We bear that in mind. We come back to that. And honestly, it reminds me of what we saw during the very early COVID days back in March 2020. Now, one prominent hedge fund manager described this as a classic deleveraging crunch. Now, what exactly does that actually mean? It means funds are rapidly reducing their market exposure by selling off positions across the board. And it's not just happening in one sector. The Goldman Sachs notes that it's industrials that are getting hit particularly hard here. Now, the fascinating thing is that while this de-risking is happening, globally, it's most pronounced in the United States of America. And when I was on a trading floor, we call this kind of a widespread selling, a correlation event. Everything moving down together, regardless of individual merit, whether the companies are good, whether the markets are good, whether the sector is good. But here is something important I want you to understand. Despite this heavy selling, the outlook for 2025 actually remains very positive. And that speaks to the difference between tactical positioning and the more strategic outlook. Now, the big boys on Wall Street might be de-risking now, but they're not abandoning their long-term strategies. They're simply adapting to what's happening right here, right now. Which reminds me of a song. If you know which one that is, put it in the chat. Now, let's talk about how everyday investors are feeling right now. According to the AAII investor sentiment, which is sort of like the Alcoholic Anonymous of the investing world, for 3 weeks in a row, over half of people in the market have been pessimistic about the next 6 months. That's really significant, very significant. And to put this in perspective, we haven't seen sentiment this negative since March 2009, the very end of the global financial crisis. And anybody who invested in that period knows what happened next. The market bottomed, and it began one of the longest bull runs in the history of the world. And this gets to a fundamental truth about markets that I've seen play out again and again and again. Investor psychology moves in cycles and predictable patterns. We go from euphoria to panic and back again. And right now we're firmly in the panic phase. But here is where it gets interesting. Extreme bearishness often precedes a bottoming process. Big, beautiful, round bottoming process. And in my experience, this emotional roller coaster is rarely rooted in actual economic fundamentals. It's more about human nature. When everyone's selling, that often presents an opportunity. Think about it this way. Did anything fundamentally change about the US economy on March 10th? No. But prices dropped 4% in a single day. So here is what disciplined investors, trained investors, I should perhaps say, do during those times. Well, they embrace risk management techniques. That's the first one. They might sell when the market falls below key support levels, like the 200-day moving average, as the big boys are doing. But then, and this is crucial, they re-enter when prices recover, effectively increasing their positioning size at a discount. Why? Well, if you sell stocks at 100 and then they drop to 90. When you buy back in, well, how much more stocks do you get? Well, you get the extra 10% stocks, right? So you now own more shares. So when the market recovers, you make more money. So tell me what you're seeing in your own portfolios right now. Are you feeling the panic or are you staying disciplined? And be honest about it. Put it in the comments. This is a safe space here. I'd love to know. And tell me how you are handling this market correction right now. Let's also take a closer look at what the broader economic data is telling us, because this is where things get kind of interesting. Inflation is currently running at approximately 2.8% according to the bean counters of the US government. Not terrible, but what's concerning is that core inflation is sort of stubbornly resistant to coming down further. And the Fed is therefore in a bit of a bind here, trying to balance controlling inflation while also supporting economic growth. Now, there are a bunch of private sector inflation indicators that are much lower, and I believe that data more, honestly. So I actually think the inflation story is kind of one that's it's overcooked, really. But one question that I get asked all the time is, Felix, when will interest rates come down? Well, despite what many consumers would prefer, these persistent inflation numbers, at least on the headline, are above the Fed's target. So we're not going to get that immediate pivot this week, what we would like. And this matters to you because it directly impacts borrowing costs for everything from mortgages to business loans. The employment picture, the jobs market, offers a bit of a silver lining. Unemployment currently stands at about 4.1%. That's quite low historically. But is it enough to offset other concerns? Economic growth has been, well, sort of tepid. The Atlanta's Fed model, which revised its Q1 growth estimates to a negative 2.4% just last week, which would scream recession. Now, the Atlanta Fed model is probably one of the daftest GDP models anyone's ever come across because it takes into account, like all GDP data, imports. And when you tell the world, I'm going to put lots of taxes, as in tariffs, on your imports, all the importers are going to import as much as they humanly can before the deadline, before they have to pay the new tariff. So we've seen a spike in imports for that reason, and therefore we get this negative GDP number. It doesn't mean the economy is that bad. But what about the consumer? Well, retail sales and the overall consumer activity have registered their most significant decline since 2021. Why does this matter? Because consumer spending accounts for about 70% of US economic activity. 70%. So when the consumer pulls back, it directly feeds into corporate earnings, which impacts investors' confidence. It's a feedback loop that can accelerate, well, in either direction, up or down. So given all these slightly concerning indicators, should we not be running for the hills? Not necessarily. In fact, I'd argue that the bearish sentiment we're in right now, while it feels alarming, it actually is a beautiful tactical buying opportunity for the trained investor. And look, I've studied market psychology for years, and the pattern is clear. Extreme negativity often signals an impending bottom. We saw it in 2008, we saw it in 2020, and numerous other corrections. When everyone's pessimistic, that is often when the smart money starts positioning for a rebound. And to be clear, I'm not calling for indiscriminate buying here. Rather, I'm suggesting strategic nibbling at discounted prices in either quality companies, and avoid those with weak fundamentals, or buy the index, because that's always the safest place to put your money, if your time horizon is long enough. And then, of course, there's the potential silver lining. Trump administration is trying to get all the bad news out of the way, and then we're going to get some sort of fiscal stimulus, which means tax cuts, which means more spending on maybe infrastructure and stuff like that. And that could provide the catalyst for a market recovery that we want. And if you look at the charts, where we are, but compared to moving averages and all that kind of glorious stuff, it basically just says, look, nothing unusual is happening here. This is normal. This actually happens pretty much every year. We go down about 10% once a year. And it's typically near where we bottom. Now, do I know when the market bottom happens? No, I don't. But we can make decisions based on past behavior that allow us to be closer to it than not. So what I want to get across to you is, you don't want to be selling near the market bottom. Right? Maybe you want to be buying near the market bottom. What you do also need to learn is how to sell near the market top, and not at the market top, because that's impossible, but near it. And that way you lock in those gains. And then as the market dips, you make money, because the market moves in cycles, in patterns. And the patterns are really pretty easy to spot once you know what to look for. And I give you that knowledge and those tools for free if you go to felixprehn.org/get free, because I want you to actually get free. So what about the big funds doing the selling at the fastest rate ever, the hedge funds running for the hills, all that? Is that therefore the end of the world? All that is, what the hedge funds are doing is risk management. So once those professional app operators start deploying capital again and Winston doesn't knock over all the lights, markets can move surprisingly quickly to the upside. So what's the takeaway here for you, the investor? Well, investors with enough liquidity and a willingness to tolerate some short-term ups and downs may find themselves very happily positioned to benefit from a market rebound. Now, the key is having both the capital and the courage to act when others are fearful. So how do you get the courage? You have to learn the rules. Now, let's talk about why certain companies are actually positioned to thrive despite or even because of this market correction. Specifically, I want to focus on the Palantir ecosystem here today, which perfectly illustrates why what I look for during uncertain economic times. You see, the current environment with all this repositioning and the risk management and so on, it creates opportunity for companies focused on their fundamentals. And that's exactly what Palantir actually enables. And what Palantir gives its customers are 4 key capabilities. First, cost reduction, more efficient. So when consumer spending is declining, as we're seeing now, and companies desperately need to trim fat without cutting muscle, this is where Palantir-driven optimization proves its worth. Second, data-driven real-time decisions. During market shifts that are rapid, tariffs and all that kind of stuff, we need information faster than our competitors to create real competitive advantage. We can't wait for weeks and weeks and weeks for the consultants to come up with this stuff. And then third, it's scalable automation. There is still a pretty tight labor market, and the ability to do more with less becomes critical, therefore, so automation can scale up or down depending on your demand, and therefore be a very, very low-risk way to growth. And then fourth, just being able to respond to changing and challenging conditions. When the economic landscape shifts, as it appears to be right now, companies need systems that can adapt quickly, and those that pivot fastest will outperform. So let's dive deeper here into Palantir specific. While the broader market experiences the up and the down, their business model actually demonstrates real resilience. Why? Because they have very diversified industry exposure. They have clients from healthcare to retail to aerospace to defense, and their platform works across all of those systems. It's kind of the portfolio theory of the investor applied at the company level, right? It's rather brilliant. Now, the second factor that stands out is what I call stickiness. These are mission-critical implementations that aren't easily removed if you want to cut budgets. AT&T's presentation showed how Palantir powers over 600 applications. And that level of integration makes it almost impossible to rip out the software. Right? But perhaps most relevant to the current economic climate is Palantir's ability to drive efficiency. Walgreens said that they have a 30% operational efficiency gain after using Palantir software. Think about that. 30% improvement in operational efficiency when margins are being squeezed from all directions, tariffs included. Their recurring revenue model is another strength during uncertain times. Unlike one-off sales that can quickly dry up in a downturn, Palantir's platform nature suggests stable, predictable revenue, exactly what investors crave in times of this sort of madness, right? And I was very struck by what CEO Alex Karp's opening address was at AIPCon, where he emphasized Palantir's ambition to be the best value-creating software provider in the world in 5 years, in 10 years. And that kind of long-term vision that extends beyond today's cycle is exactly what I look for in leadership when I pick out good companies. So how do we potentially trade Palantir in the current environment? Well, this isn't just about buying on dips and that kind of thing. The key is understanding how their fundamental business model aligns with what the market needs most right now. And I found that companies with proven cost reduction capabilities often see their stock prices recover faster than the broader market once we come out of the dip. So let's have a look at the stock chart. And the first thing I would always do, and this is Trade Vision here, which I've got open, which is the platform that we built to give you access to the same quality data that Wall Street has access to. put in two moving average line. I did it rather quickly there, the 50-day and the 150. I just pop those in, and you can follow along as I do this. There's a free trial to Trade Vision. And then what do you see? Well, you see that we are slightly, actually, as I'm recording this, we're actually above the 50 again. So the 50 is sort of, you're above it, like things are good, right? You are a very happy chap. If you are between the 50 and the 150, you are feeling a little bit worried. Not terrible, but a little bit worried. And below the 150, you're like, oh my God, what's going on, right? That's sort of what those lines mean. Now, we're nowhere near the 50-day moving average line, which is that purple, that is the 150 days, down here. We're pretty close to the 50 or slightly above it. That's pretty good. And if you look at most tech stocks, we're right now below the 150 or even below the 200. We're like down here. This is where most stocks are. Palantir has weathered this dip actually very, very, very well for a perceived high-risk company. But let's look at another company that caught my attention during the AIPCon presentation. Walgreens. Now, at first glance, you might think a traditional pharmacy retailer would struggle during, slowing economy and all that, but their presentation revealed why they may be better positioned than appears on the surface. First, Walgreens has undergone a remarkable transformation on the inside. They now identify as just kidding. They've integrated about 25 data systems in just 45 days, and they now have a comprehensive digital twin of their entire pharmacy operation. This isn't just tech for tech's sakes, it enables real-time load balancing across 4,000 stores. So what does that mean in practice? Well, imagine you're a Walgreens executive responsible for staffing across thousands of locations. Previously, you'd make educated guesses about which stores need more pharmacists and when, and now you have a system that can predict demand patterns and shift resources, both human and inventory, in real time. And the results are genuinely impressive. 30% operational efficiency improvements and a 32% increase in patient engagement. They're not just vanity metrics, they directly impact the cost structure and revenue in a business where margins are pretty thin, because one pharmacy is pretty much the same as any other pharmacy, right? Now, another aspect worth considering is Walgreens provides essential services that remain in demand even during slow economic times. People still need their meds. Well, a lot of people maybe should be taking their meds more often, regardless of market conditions. And perhaps most fascinating is their shift from manual to automated decision-making. So their representative mentioned that what would otherwise require 384 billion decisions every day made manually has been transformed into an automated orchestration system. That's not a typo, by the way. 384 billion decisions. I know. Every day. Winston makes about 3 decisions a day. Should I sleep on the bed, the couch, maybe my comfy chair back there? Winston, where are you right now? Come on over here. And it's quite exhausting for the poor chap. Just those 3 decisions. Imagine 384 billion decisions. There he is. He looks exhausted, doesn't he? A lot of hard work putting into all this research here. So how do you invest or possibly trade a thing like WBA right here? Let's pull up the chart. And what have we done? We've got the same metrics on there. And what you actually see is that Walgreens has done quite nicely out of this. Now, Walgreens has been for a very, 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 very long period of time what I would term a falling knife. It's just been, may I draw a line? It's just been absolutely decimated, coming from $55 to $11, as people realize that, well, vaccines are not quite what they're promised to be and that sort of thing, and just generally a tough economy. But what we've just seen is remarkable. We've seen in Feb, as most of the market was collapsing, stock moves above the 50-day moving average line here again, stays above that, moves above the 150-day moving average line, and maybe these lines are new to you, but they were really quite important. And now we have a sloping up line there. We had a nice gap up here, and we're actually doing quite nicely. So it's almost like it's a defensive play into uncertain times. Now, there is still a little bit of a problem-ish here, which is there is still this sort of pattern. And you could also draw one from here, something like that. And what does that say to you? Well, it says to you that we have had higher highs recently here, even there, and therefore we need to break through those, right, to really get a meaningful breakout. That's a little bit the challenge here with it, but it looks like they're doing quite a good job, and perhaps because of Palantir. But let's switch gears for a moment and look at a company that's operating in a very different sector. Archer Aviation. Despite the challenging market backdrop here, their presentation at AIPCon and their partnership announcement reveal a couple of very important and compelling factors. And if you're unfamiliar with Archer, well, they develop electrical vertical takeoff and landing aircraft, essentially air taxis. Now, you might be thinking, surely that's a pre-revenue aviation company. There's the last place I want to invest during uncertain times. Well, but bear with me. What makes Archer particularly interesting is how they are leveraging tech for manufacturing optimizations. They're using Palantir to address the critical challenge for capital-intensive businesses during economic uncertainty: efficient deployment of substantial money resources. And one aspect I found particularly innovative is their cross-value chain integration. So their partnership between Archer and Anduril, both Palantir customers, by the way, enables synchronized requirements and communications between manufacturing teams, and it reduces costly errors and delays that traditionally plague aircraft development, especially across partners. And in terms of real quantifiable benefits, Archer mentioned saving a double-digit % of time just on labor overhead through their Palantir implementation. So in an industry where development costs can run into billions, these efficiency gains translate into substantial money preservation. But what really struck me was their vision to make aviation ubiquitous, autonomous, and electric. So Archer represents a forward-looking investment that may be undervalued during market corrections where everybody hates the risky stuff that's flying around in the sky. Let's figure out the self-driving first before we do the crazy thing of self-flying, right? Could be a good opportunity. So how would one and when would one invest in a thing like Archer? Well, let's have a look at the stock chart here, and you tell me what you see in the comments down below, and I'll tell you what I see. So what do I see? Well, we called a very nice breakout here on that date. That was the breakout. And somebody would now going to be saying, but that's a wrong breakout. It's not actually. It's a beautiful, perfect breakout line. Because once you understand risk management, which is why the hedge funds have been selling, they literally draw a line in the sand like that. Where will they sell? They'll sell here. Right? So they will take that gain, which was about 20% in the space of about a month. Not bad, right? And they'll get money. Whereas, of course, retail hurdles and therefore struggles. There was a clear warning here to sell. Now it's bouncing off, thankfully, and it's coming back up, and I think it'll probably be fine because, well, we're going to go up to here, and then it's going to go a little bit sideways because all the people who bought here and have been keeping secrets from their wives about the amazing stock that they just bought that's now down 20%, they're going to sell, right, when we get to here. And then we might come down a little bit, and then we'll do the same thing, and we go sideways, and we might be able to go back up again. So there is that sort of pattern here. So it's not my ideal buy spot as we are below the 50-day moving average line. I would prefer to wait for this to start slipping up again, and I'd rather pay a little bit more and employ my capital more efficiently. A few more on that and how the rules really work in the masterclass down below. But it looks like an interesting point. It looks like an interesting one to add to the watch list. Now, were there other big companies mentioned? Yes, there was AT&T, there was Heineken, there was Qualcomm. There were a couple of others that I think are worth looking into, and you might want to do that, but I also don't want to make this into a 2-hour-long video because I appreciate people have short time here. So I think there is potentially tremendous opportunity in the Palantir customers, because it shows you these are people who are really adapting and adopting to the new technology that is AI. They're going to improve their margins, they're going to run their businesses better, and they're going to come out of this dip thriving. So if you found this information useful, put it down below in the chat, or better yet, just share it with somebody who might benefit from it, maybe even a golden retriever. And if you really want to learn how to spot these patterns and what do I buy on the recovery? Because the recovery is going to come, and maybe it'll take a week, maybe it'll take a month, but it's going to come. And you want to know what you do and how you position yourself and what you do with your money in the meantime, right? So for that, I want to give you the rules that took me about a decade to learn from my mentors. And I want to just deliver that to you because I think it's like a basic human right. Everybody should know how to make their money work for them. I love you for watching. I love you for tuning in. And I hope to see you on the next one. What if I told you there is a stock so undervalued that its CEO is considering buying the entire company? Wall Street analysts can't explain why it trades at only 1.6 times earnings, while its competitors trade at like 3 times higher valuations.